The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Hello, I'm Brian Akers from Akers Financial Group, and we welcome you to Winning in Retirement. Today, I have certified financial planner practitioner Alex Monk, who works with Akers Financial Group and has been for over 11 years. He's one of our investment committee specialists and all-around good guy. Does that sound the right way to introduce you, Alex?
I'll take it.
All right, good morning, Alex Monk. I'm glad you're here with us today because I got a hard subject for you. It's tough.
Sign me up.
All right, the hardest thing about this subject will be actually saying it. That's going to be the hardest thing. All right, the show's called Winning in Retirement. So guess what? We think about winning in retirement all the time. And we think about an idea called how do you invest and win?
Winvesting.
You said the word already.
I had to.
Winvesting.
It's good.
That's how you win in retirement with your investing is winvesting.
Well, you definitely don't want to lose with your investments.
And do we say patent pending at this time?
TBD.
Sure. That sounds good. All right. So the idea is this. Hey, yes, you want to win in retirement. And what you need to do, you got to win at the way you invest your money. Are you properly winvesting? Are you going to win with your money?
Yeah. And that's a serious question, right? Because
I'm trying to be serious. A little funny at first because the idea is it's a new word to everyone, winvesting.
It's a funny way to say a very important thing.
And that's let's make sure your investments are winning, not the losing.
I mean, when you say it, it's so simple, right? But
it's not that simple, is it?
It's not simple at all. I mean, how do you take risk? You have to balance all these different things inside of a portfolio. Mm-hmm. And with all these options that are out there, Brian, I don't know how people make the decision on their own.
I don't think they should or could. I think they should have coaches and help and experts in different categories because no one's going to be an expert in everything. What you're going to find is there's experts that help guide you and coach you and lead you along the way and know when to bring someone else into that team of people that you need to help you winvest, help you to win at your investing.
So kind of like your general practitioner, he knows that your knee is a little wonky.
All right.
And we got to bring in a knee guy.
Right. Or a knee person.
Yeah. Whatever.
You need somebody.
Yeah. We need.
Yeah.
So, but that's, we take kind of that role, right? That coach to help these people win in retirement, win in their investing.
Right. And so we have to have an approach to answer that for our clients. And that's what we've developed over the last 30-ish years is coming up with what is winning? How do our clients win in retirement? What does winning look like? And does winning just have to do with investing? Can it do with many other things?
So let's start with what is winning?
And winning to me is not a number. It's not, you hit this jackpot number and then boom, you won. It's over. Game over. It's a matter of the ability to live the retirement life that you dreamed of. And a reasonable dream. Let's not go too crazy on that dream. A reasonable dream. But you're living that dream and the stress level is lower because of the way you've built your investments, the way you spend your time, the way you invest your time, commit your life to different things. It feels like you're winning the way you live your retirement years.
So kind of like that relief, that financial independence is the goal.
Like I had a client in my office the other day. His wife is sitting there like 6-7 years ago. She lost her job. And they came in and she's like, I lost my job and I don't know what to do. And the husband's like, I'm going to have to work forever. And we're working it out. And then yesterday was the meeting where they said, we'd like to retire. The husband goes, I could fully retire next year. And then we talked about retiring 3 months earlier so they could do certain fishing trips and stuff. And I'm like, let me check everything. We've answered all my questions. I said, all right, how about May next year? We just go with that number and that's be when you retire. And he's like, okay. And I said, I have to go get some forms and stuff, some paperwork. And the guy goes, hey, if you hear yelling and screaming in here, we're just happy dancing. Basically, they're winning because they know that they did all the hard work. Because there's a lot of hard work they had to get ready. Because imagine that wife comes home from work one day and says, I'm out of my job. And she was making really good money, and all of a sudden it's done. And then they have to still try to reach retirement years without finding that kind of job ever again.
Right, and then your goals may change, your reality may change, but that's like two different spectrums of meanings.
But the happy dance is part of the win how you win in retirement.
That's
my answer.
when, they've spent the time, where their money is, they know where their money is.
They know their bills. They know what their goals are. They know where they might want to live. The reason I always say might, because they have not narrowed it down, because they're the one son's in the military. They don't chase him. They don't want to chase him down until he gets out of the military.
Yeah, that's a good call. That's tough.
Life is hard. There's a lot of decisions. Financial planning is not a stagnant thing where you plan it once and you're done. I mean, if you have someone that sells you a product and then that product, they basically say, here, you bought it, and then that's good, and then you never hear from them again, that's not planning in any way.
No,
that's just a product sale. Understanding the difference and having an advisor versus someone that sells one product is the difference in how you're going to win in retirement. Winning by accumulating products probably isn't going to be a win unless you know how to use those products and everything and tie it into exactly what you want in your financial plan.
Yeah, and that's my favorite part about our style of working with clients is we don't go away, right? So we get to see as their life changes, and that's the most fun for me. It's seeing those different stages and those new things that happen along the way, whether they're good or bad. Life deals the cards.
It's my retired clients. I've been asking them, are you winning? That's how it's like one of my starting points in my new meetings recently. It's just, are you winning? And like some of the times the answer is, what is winning, Brian? And I say, well, what do you want winning to be? And they go, then we're winning. It's a fun conversation because honestly, the more news they watch or listen to, the higher the stress level. They don't feel like they're winning because they're told that you need to be worried about things. And then they look at their money and I say, well, the volatility of the markets should not be your volatility for a retiree. To win with your investing, you need to reduce your volatility. The volatility is what, Alex?
That's your swings, your ups and downs, your elevator, if you will.
The elevator, like 10th floor and first floor versus just up and down first and second.
Right. Versus, a rancher. So that's like the changes up and down, your risk.
All right. So winning in retirement, you must begin with Winvesting. Yes, a new word. And you're driving your car going, do I have to listen to this Winvesting stuff? And why would someone want to listen to this?
Well, if you're listening and you're like, hey, are my investments correct for me?
Okay.
Like I picked this fund 10 years ago. Like you're sitting there $6.95 trying to get somewhere around the loop and you're like, oh, I haven't looked at my 401k in 15 years.
I don't even have a login. That's what I hear from people.
Yeah, I got this statement, I think, last year. Then you should, if that's you should call.
Or have someone that they say, I'm 50 years old. I haven't looked at it since I joined the company 18 years ago.
Yeah. That's
like, let's look at it. Let's see if it's different. Or a company changed 401k providers, which is happening all the time now. And then they said, oh, I haven't logged into the new site. I don't know what it mapped over to. Well, let's find out.
Yeah. Did your beneficiaries come over?
This is not your average way of investing money when we're going to describe throughout the show today. Yes, you have to listen. You're going to have to listen once, twice. The way you do that, you go to our website, acresfinancialgroup.com, hit the radio tab and listen to the radio shows right off of there. Or you can go to the podcast, Winning in Retirement, and actually listen to different shows, especially this one, to understand Winvesting and how to apply it for your life to make sure that you are thinking through how this money should be invested to meet whatever your goals may be.
That's huge right there. You said goals, right? So that's how we figure out if we're investing right.
Right. So what's the purpose of the money?
Yeah. It's just.
So what do people tell you their purpose is with the money?
It depends. So people come in for different things, right? They come in and, Alex, I just don't want to lose.
Yeah.
Or I have no clue where my money is. Yeah. Or am I doing the right thing? That's the biggest one.
All right. So it might sound like I had a lot of meetings recently, but it's going to sound like I had 20 different directions when people talk to me about what they want their money to do. One person is, I need as much income as possible from the money I have. I don't feel like I have enough. And so we have to look at it that way. The next one was, I want to save in retirement. You've heard that one where, I want to save $1,000 a month to my bank account out of my income. And it's like, well, you're not taking enough out. You're not taking money out and then paying the tax and then saving it for no reason. Well, let's create a better plan. And then there's the one where it's like, I feel like I have more than enough. I just got to figure out what I'm going to do.
I have to get rid of this stuff.
Well, that happens like in the mid 70s is when they've lived through the hardest retire years, which is the 50s and 60s, when you're trying to figure out how much of the principal to spend, if anything, and let that money grow, trying to get it to provide you through all those years where you're really trying to do the things you always dreamed of, which all cost money. And then you get through that time period and there's still money there and doing all right. And you're like, oh, what do I do now? And that's okay.
Yeah, I mean, there is no right answer for how you want your life to look, but we want your money to work for you.
The easiest thing to do is when you're a saver and you've done well is to call a financial advisor and you say, am I doing okay? And you want them to say yes. And you've had people do that, right?
I have. I mean, I that's my favorite thing is just to see where things are at, show you my opinion, and then people get their own relationship with that.
All right. Does Alex Monk tell them what they need to hear or what they want to hear when they ask you that question?
Well, considering I never know what people want to hear.
Okay, so you don't just worry about that?
No, and a lot of times I don't say anything the first meeting, and they look at my face as I'm reading through documents, and apparently they can
tell from your eyes.
There's a tell, like if my eyebrows are doing too much, but I want to go through it all. That way I can tell people this is the facts. What you do with it is up to you, but this is the facts.
Yeah, so the process of Winvesting is this concept of understanding what you want your money to do for you. Then the process is coming back with answers, good answers, and even tough answers. Ones that say, yes, you're doing well at everything, or no, we got to fix some things. There might be a leaky faucet or something.
And I'm going to be the one to fix that problem first because I like people to be successful long term.
Absolutely. So you identify the issues, you prioritize them, and then you start to winning through your investing. That's exactly what we do at Acres Financial Group. We're local. We're independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Forest Hill and Lutherville and clients all around the state, all around the Mid-Atlantic region and around the country. It's so easy to begin winning in retirement. Just give us a call and schedule your meeting with one of our team of advisors. Call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to acresfinancialgroup.com or call 833-946-7384 to start planning for your retirement now. What is the rule of 100? You will really want to hear this. We'll explain when Winning in Retirement continues.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Yes, welcome back to Winning in Retirement. I'm Brian Akers from Acres Financial Group. I'm founder of the Acres Financial Group and actual president of Acres Financial Group. And here with me today is Alex Monk of Acres Financial Group. He is I was trying to describe, you graduate Taos University.
Yep.
Accounting degree. Certified financial planner practitioner. Got the CFP designation.
Yep.
And taking all the credits every year or two now, right?
Actually, a year in advance, but, you know.
Yeah, that's nice. You got to keep the learning going.
Oh, yeah.
All right, and I think I'm trying to figure out the answer to this one. Which one are you more proud of? The wife that's way out of your reach that you were able to be blessed with, or the son that came last year?
Oh, definitely my wife.
Okay. I don't know. The son's a pretty big deal, too, though. Yeah. All right. It's fun for me to watch you turn into a family man. It's pretty cool. All right. So the reason I bring that up is this. When the financial advisor has been in Harford County your whole life, is that right, Alex?
It's true.
He's here. He's going to be here. He's going to be working with you and helping you and advising you. That's important because what we're talking about here is this. Financial planning or Winvesting, winning and investing for your retirement years, you want an advisor who's going to come along your side and be there to guide you into and through retirement years. all of that.
I mean, I see some of my clients at the supermarket, so
Yeah.
I want to everything I do, I'm going to stand up by.
Yeah, it's fun seeing them where you don't recognize them.
Yeah, they always like, how's my money? And I'm like looking at tomatoes or something. And I'm like, what?
It was worse during the COVID time when everybody's in mask and you're thinking that's somebody, and then you can't really talk. It was weird. You just wave.
I mean, I think that's like the best part of our job is these people, we know so much about them. We share their experience with them, and I absolutely love it.
Right. So our show today is called Winvesting, winning at investing, especially during your retirement years, and how at Acres Financial Group we go through the process of thinking about it and how to make sure that you're going to win at investing. And we created a word called Winvesting. Now we're going to start with a little thing that I learned growing up on the radio. I like radio shows. I've listened to financial radio shows since I was a lot younger. And there's a guy, Julius Westheimer in Baltimore, an excellent financial voice for Baltimore for many years. He would say, you take 100 minus your age, and that'll give you the amount of money, percentage-wise, approximately, you should have in stocks. And so if someone's 60 years old, 100 minus 60 is what, Alex?
40.
That excellent accounting job there. So 40 would be the percent in stocks for a 60-year-old in that little formula. Then he said, well, you could run that up 20% more, and so you could be more aggressive or less aggressive than that. So you could put 60% in stocks if you're 60 years old.
Okay, and that's of what?
Of the money that you have that's investable.
Okay, so not including your house and your net worth.
Yeah, right? You don't count your house. I don't even count the emergency fund because that's money that's about ready to be used. Yeah. I'd count something else. Now, my wife's a math major, and so I told her the formula, 100 minus age equals amount in equities. I said, can I take the age and make that equal money not in equities? And she goes, yes. That's, like, the fancy word would be algebraic. I can't say the word. It's mathematically correct. And so what happens is, so your age is the amount of money that you would not have in equities. And what at Acres Financial Group, what we try to do is talk about having money protected from zero downside risk.
Right.
And that is really the process of trying to identify having some money in your portfolio, your investment portfolio, that is going to not lose when things are terrible.
Absolutely. Now, the age minus 100 is our rule of thumb. Now, there's different cases.
Yeah, it's not like a hard line. It's just like a little quick guideline. If you want me to answer quickly, I'll tell you that.
And I think that's such an important thing because we see people, they come in and I've seen 70-year-olds come in 100% in equities.
100% in equities or 100% at risk. And the difference between that is you might have equities, but a target date fund will put you into the bond side. And like we learned back in 2022, it can lose just as much as the stock market when interest rates go up. So you're not putting money in to protect it.
Right.
One of the best things about interest rates going up is that savers actually can earn money off of things from banks and insurance companies. They can earn CD money and actually make better interest rates than they've had in a decade.
Yeah, and it's been years since we saw decent rates at the bank. And the whole interest rate thing, that's fine, but we don't want to run and chase that. Mm-hmm. Like, that's got to fit because equities will have their day to shine too. And I'm not going to be the guy that's going to tell you the date when the market peaks or bottoms.
You're not?
No.
All right. So you don't know that when the market's going up this year?
No. And
next year?
I hate being wrong. So I never answer that question.
Now, the reason we want money protected, what is that reason?
So when things go bad, mm-hmm. I can pull from somewhere.
So you can take money out of the account that's not down?
Absolutely. Because if you, let's say you're all in stocks, right? The stock market's down 10%, but you're retired. You need money.
Right.
You're selling. You're locking in a loss.
Yeah, I mean, like, the math of that is if the market loses 10 and you're 100% in the market, you lost 10.
Minus your 5% withdrawal or whatever you're taking out.
Yeah, it's even more.
That's 15%.
So if you actually had your money in the market, half of it in the market, and the market went down 10, your money only lost 5% overall because you had to diversify just simply between something protected versus at risk.
Right. And then in that scenario, if you pull from the side that's not down, mm-hmm. you give your riskier money the ability to recover.
Because you don't have to touch it.
Because you can leave it there.
One of the biggest mistakes we see, there's so many, but one of them is you'll have an investment account. It's managed by a computer. That computer sells every month the market investment and sends you a monthly check.
Yeah, that's fun.
And you see on your monthly report all these sales because they got to send you a check. That means they're doing reverse dollar cost averaging, which is one of the major things to not do. It's just wrong when it comes to timing the market on the way out. You need to time it and try to take it out on when things are high. You don't try to do it every month and just pour it out.
Well, what that says to me is that there's no plan overall for how cash flow's coming.
Oh,
right. There's no thought.
That means they want to invest your money. They invested it. Hey, you need $500 a month. All right, we'll send it to you.
And I just, if you know you're going to be spending $500 a month, why would we not have that in cash for the year?
Right. Especially if cash can make 3% or more, depending on where you invest in the money market.
Especially when your time horizon's 1 year, your amount of risk just amplifies. So,
all right. So on protected side, the banks offer what kind of protection?
The FDIC, which is a real thing.
Is a real thing. You might say underfunded. The federal government has to address some of that. They're going to do that through some ways of charging more premium for the insurance at the banks, especially for higher valued accounts. And then the insurance companies, how are they protected?
So the insurance companies are rated by like Moody's, Fitch, credit rating agencies based on the amount of assets they have on hand, where they have to have a surplus. So if they owe you $1 in your life insurance, they have to have $1 plus.
Right. So the insurance companies will have one piece of their company to be a guarantee corporation. So any fixed business that has a guarantee to it is in that. The other pieces of the companies are their variable and their riskier products are not in the guarantee corporation.
Yeah, they're completely separate.
And that was something that lots of people learned back in 2008 when there's issues with different brokerage firms that went under over weekends. It was a tough time back then, mortgage crisis.
Everyone from 2008, most people remember the name AIG.
Right.
They're all that went under this terrible debacle, except for the people that owned their annuities. They're fixed annuities.
Right. Their fixed insurance had a surplus, and I even had a client that had one of them, and when it came due the month after, they got 100% of their money out. They were at that nervous phase, and they came to see me and say, is this worth anything now? Now, the crazy thing is that if you had bonds in those banks or insurance companies, you lost money, then it came back a year later or whenever TARP came out. But historically, what happens is this. Insurance companies have their own assets to back them up. That's really their guarantee. Then they have the industry to back them up. That's really where the guarantees come from. The states have their own little fund for money. I don't think you should consider that when you're looking at safety. I think what you should consider is the fact that if it's a fixed guaranteed annuity, is the insurance company been there a long time? How are their financials? And understand having A rating and higher on AM Best would be a good way of just beginning your analysis on any type of fixed guarantee.
Absolutely. And I tell people that all the time. I don't want to take extra risk with my safe money. Right. That doesn't make any sense.
Correct. But that's what people do with bonds. And that's the thing we get a little upset about over the last a long time. We've been on the radio. We've talked about this the whole time. When interest rates rise, your bond values will go down. That's bond funds, especially. Even short-term bond funds, the ones that are supposed to be low duration or supposed to have lower risk, have lost money because interest rates, when they go up. Now, the next little topic is let's say we're laddering. Explain the concept of a ladder.
All right. So ladder's basically just spacing things out.
Okay.
Or, going up rungs, however you want to look at it, stair steps. And essentially what you want to do is you want to take the risk when you do your safe money is locking your money up too long, right?
Sure.
5 years CD, whatever it may be.
Because we're not rewarded generally for locking in an extremely long time. Extremely long would be beyond 10 years.
Correct. So right now, the most reward you're going to get somewhere in that 5 to 7, sometimes 10 range if you're doing something different. But You want to have things coming due at different times. You never want to have everything all illiquid at the same.
Absolutely. So the idea of laddering might be where you keep money liquid for all your expenses for the next 12 months. You put next year's money into something that's 1 year and comes due in a year, and it comes into the account that you need it, and it fills up the next year. And sort of you ladder out the sources. Now that cash can actually make more money, this can be done. At Acres Financial Group, everything we do is about you. Your retirement is as unique as your fingerprint. When you sit down with us, we start by taking a look at your financial fingerprint. We talk about you and where you are right now. What is your net worth? How do you invest? How much are you earning? Then we talk about what you want to retire and how you want to retire and what do you want it to look like, feel like. What's your retirement fingerprint? Perhaps you've been sold something, regardless of whether you needed it or not. Not at Acres Financial Group. With us, your retirement money follows your financial fingerprint. It's a retirement plan based on your unique fingerprint that determines where your money goes. It's not about us, it's about you. So give us a call at 833-WIN-RETIRE and schedule an in-person or Zoom meeting with one of our team of advisors. That's 833-WIN-RETIRE. That's WINRETIRE. Or you can call us at 833-946-7384 or visit our website at acresfinancialgroup.com. Scroll down to the bottom of our homepage and schedule a meeting right there. Do you only invest in what's comfortable to you? We'll explain when we return for more of Winning in Retirement.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers. Today with me is Alex Monk. We're both certified financial planner practitioners from Acres Financial Group right here in Maryland. We work with people all around the area and all around the country. Alex Monk, welcome to the second half of the show. You warmed up?
I'm ready, Brian. Let's do this.
All right. Today's word of the day is called Winvesting. Please define and say where it came from.
Well, I don't know exactly where it came from. I think it's a brainchild. I don't know. But we don't want to lose when we're investing.
We don't want to lose what we're investing. We generally want you to win at investing. And the win is to win all the time. Be nice, but that's not always possible as you diversify.
Now, winning overall, right?
Yeah.
Because if we're going to take risk, like equities, things like that, risk is a real thing, right? Yeah. So we're risking principal or we're risking something. In equities, it's principal. So, yes, we have to size that risk and take it, but we have to be able to balance it.
Has there ever been an NFL football team that's gone undefeated? Do you remember the one? I'm sorry, I just cheated. I told you the answer. Do you remember the one team that did that?
Yeah.
All right, so there was one team that went undefeated. Everyone else has lost one or more. And so the idea of always winning with everything is near impossible. You want to generally positively win as often as possible.
Well, that was only 1 year they did it.
Absolutely.
So
only 1 year of all the teams. One got real close. Not going to mention who it was. And they lost in the Super Bowl. But beyond that, Winvesting is where we're going to take our money, invest it based on our purposes, our own goals, and we want it to win for us. So the winning is defined by you, not by someone else.
You get to define the game. Retirement is everyone's own game.
And that overwhelms some people. It does, because they think, I don't know what I want. I don't know what I need. And that's what we got to try to uncover is really what is retirement going to be for you. And
it's a tough thing because, right, you might hear some advice from your neighbor, the guy you play golf with that owns Tesla, whatever.
Yeah.
All these different noises.
So what happens, I got to ask you this one. All right, so the topic this quarter is, do you only invest in what's comfortable to you? So do you ever have a new client come in and all their money is in one place or one style or one investment?
Yeah, so it's a lot of times, sometimes it's all in company stock, or let's say they've owned real estate their whole life and that's all they own.
Right.
So then we have liquidity issues, or they own nothing but stocks, equities that are all high risk.
Or they have it all in the bank.
I've seen that too.
And so the idea is, is that going to be the best thing for them to meet all the goals that they have? Understanding that it might not be the right answer for their total plan.
Right, and it's a lot of times it's just because they've never had exposure to it or tried it, or they don't understand it.
Well, they get comfortable.
The first time you had sushi, I'm sure that was not comfortable.
I'm sorry, that was off the wall. But you're exactly right. First time I had sushi, I remember going, California roll, it was awful. And now I know, don't eat that. That's not sushi.
Right. And now you love it.
But they told me that was sushi, and I was like, beginners eat vegetables wrapped in seaweed, but not my favorite. Now, I do like sushi.
So
it's proper.
That's the same thing, right? You may not understand what an annuity is or what stocks are or what a CD is or what a money market is. But once you do, and you can see how it fits,
I got to tell you this story. It's like 20 years ago. I'm doing a seminar, and this guy stands up and goes, "I'll never do an annuity." And I go, "That's good, sir." And then he starts telling me about why. And I said, then I gave my general talk, which is about annuities and do you understand them? And I asked him how many types of annuity he used. Well, there's one that loses money. I said, yeah, that's one of the four different types. So understanding these investments, all the kinds of investments out there, and treating them like a tool and understanding when they work or not. The weirdest thing is that guy bought an annuity about a month later. Once he understood there are some that you should not buy.
Correct.
There's some annuities that don't fit for retirees. The fees are way too high. Or in the media annuity, it gives you a check, but no one else any money. Probably doesn't fit for you. But there are some niches for annuities based on what you want your money to do. It's a tool. So understanding money and what's out there, the tools, and how they apply to your plan can actually improve on your comfort level. Because I see people come in and they might have company stock and they've been happy because they work there. They know how great things are. They have a pension. They have 100% of their money in a company stock. And I'm sort of freaking out for them when I say hello.
Very quietly.
They can see it in my face. I'm going, like, well, what do you think of this, Brian? I said, well, have you thought about diversifying at all?
And usually those cases, they've done very, very well in the company stock. And it's hard.
Yeah. And it's so well, it's like, all right, that's a great bus ride. A great ride up. Now let's diversify before you see a ride down.
Right, because let's say you lose your job, your pension's underfunded, and now the company stock you just got fired from is worth, GE situation.
I was thinking, when I was a financial planning assistant in 1989, a guy came in with 100% in company stock. And the talk that day was you need to diversify. Nah, it's been my company forever. I'm not going to do that. And the sad part is that company lost 50% between then and the next time he came in. And it was like he did not want to do it. And then there's a lot of people who gave a career to certain like telecommunication industries or that lost tons of money. Understanding when things start to rotate down and diversifying your portfolio, all very important. The issue this quarter is this: something that you're comfortable with doesn't mean that should be your only solution. And so we want you to win at investing. Winvesting would actually lead to a topic called diversification. Diversification is where you might have things that are short-term and liquid that are protected. You might have things that are liquid and in the market where you get growth, but you can still have access to money. And then you might want to protect some money for the longer term and tie in some time. There's really only two ways to make more money, and that's to increase your risk or generally increase the time you commit with your money. Right. It's just the way things work.
There's no free lunch.
There is no such thing as a free lunch.
And sorry, I got off topic there. I was going to go down that lunch rabbit hole.
Food distracts you all the time. Like sushi?
But like diversification, it's not about over-concentration and trying to pick a winner. It's about making sure that we have exposure so that we don't take those big losses. Because that's the hardest thing to overcome in retirement. Correct.
Because when you have someone that takes too much risk and then they lose a chunk, 30, 40%, and then they want to start taking income right away, and it's like, we're in a hole, and we got to get out of this hole first. Now, we hate to tell a client that, well, before you retire, you need to work a couple more years, save more, get it back up, but the reality, you might have to.
I'd rather have that conversation than the conversation when they're 85 and they have to go find a place to live or ran out of money.
Yeah, very, very true. So what happens is this. There's diversification. Some people are over-concentrated. They put all their eggs in one basket. They have to learn to diversify, to learn to build a process on how to invest, and that does take time. And how do you do that? How do you teach people Just general idea of diversification.
So I basically, in the first meeting, we'll find out, who we are, get comfortable, and then we'll get back together, and I'll just come back and say, okay, here's where all your money is. And I'll break it down by equities. So your blend of stocks across the world, global. And then we'll look at, do we have any fixed income or bonds? What kind of bonds do you have? And then we'll look at, okay, what type of alternatives or other asset classes, precious metals, gold, commodity, fixed annuities, fixed index, whatever it may be. And then I show people where it is. And typically that chart shows, oh, wow, why do we have so much here? And you do want to have certain amounts of percentages across each asset class. I can get way into in the statistical reasoning, but generally, you want to have some money in things that aren't associated with the market at all, or some things that go up, some type of wealth insurance, gold, commodities, different things like that.
All right. So you said a bunch of different words in there.
Yeah.
You used one called wealth insurance at the end there. Then you said gold. So wealth insurance is something like gold and commodities?
So the way I view precious metals in a portfolio or commodities is an inflation hedge.
Okay.
So when your purchasing power of your dollar goes down, we want to have something that's not associated with our currency.
Right. And so we take these ideas and we create a core portfolio in our management style for money.
Yep.
That core portfolio, then we can add satellite pieces of different styles of investing that can be lower risk or even higher risk, depending on the age and the risk tolerance of that client. And that's how we try to direct and design a portfolio exactly for that person so that they can win best.
So imagine, like, my favorite way to set things up is figure out how much money this person is going to need, cash flow wise.
Right. So you have to you got to understand the income first.
Right. So what are my hurdles here as far as income? And then I want to make sure that I don't have to take any risk to get that. This is a perfect scenario.
Yeah.
But I can have that money in stuff that is backed by some type of insurance or whatever.
Or paying dividends, right?
And then I can take risks. So the dividends, whatever the cash flow is, I like to have that locked down first.
Sure.
And then from there, we can take as much risk as we want.
Yeah. So the idea, what is comfortable to you, might not be what's best for you. And so the idea of looking at an advisor and that advisor saying to you, oh, you need to do this, not telling you what you want to hear, but what you need to hear, is really what you need an advisor to be able to do, is to have someone giving you that kind of a good, solid advice.
I agree 100%.
Yeah, so imagine that you come in for a free meeting with someone at Acres Financial Group, you talk with them, and then we're going to come back and explain Winvesting, just the concept of how we make this work for our retired clients, and understand what you're doing now that works like that and what might not be working in that direction. That's sort of the concept here. So the best part of actually retirement is getting your time back. You decide how to use it. Before retirement, your time is tied up with other commitments, mainly your job, A lot of that goes away in retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. You go to our website at acresfinancialgroup.com, scroll to the schedule a meeting section, and let us know you'd like to schedule your free consultation with one of our team of advisors. That's acresfinancialgroup.com, or call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to acresfinancialgroup.com or give us a call, 833-946-7384, to start planning for your retirement now. Do you want to beat inflation and increase your income in retirement? Stay tuned. We'll explain in a moment.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to the fourth quarter of Winning in Retirement. I'm Brian Akers, certified financial planner, practitioner from Akers Financial Group. Here with me today is Alex Monk. Alex Monk is proud father of his son and been married for a couple of years now. And 5 years?
Yeah.
No way.
This last.
Oh, that's cool. Yeah, awesome. Now, if you knew Monk's wife, you would understand that I know Monk's wife longer than he has, and she's a superstar, and Monk just got lucky right there.
I agree.
Or very blessed. All right, so both of us are that way, which is cool. But Monk takes that approach of taking care of his own family when he starts thinking about you and your personal finance. So yes, Monk had to learn under me as my assistant for a while, and then we let him start advising, and he's done a great job of working with people over the years. He also helps us on the investment committee. So Alex Monk is our host today, and what we're talking about is a word called Winvesting. We think we made it up. We can't prove it that we made it up. We're not talking about win with a D in there. There's not wind investing, like eco-friendly investing.
Or like a wind vest for golf.
Yeah, the show's winning in retirement, and we want to win at investing, and so we just squished them together. And today's show is called Winvesting.
I like it.
Are you Winvesting? I am. Are you really Winvesting?
Are you Winvesting in yourself?
Absolutely. Now, Winvesting in yourself doesn't mean just money. It can be the time that you spend, your commitment to improve things in your life so you can have a long retirement. There's a lot of work out there when it comes to having a very good retirement.
Well, and so there's people, I see people all the time, and they're very skittish to spend their money or this, that, and the other. And it's something I call memory investing. Like, if you're healthy and you're going to do a huge vacation, you'll remember that forever.
Yeah.
I don't want you to look back 10 years from now, have all this money and one leg and not be able to do it or something like that.
So when a client comes in and they said, I need some money to do a trip, do you say no?
That means their money.
I know. I don't say no. I just say how to do it.
Right.
Now, if someone's totally out of line, we've been trying to get them out of deep debt.
That's a different story.
Yeah,
they usually don't come to me.
They don't ask that question. They know where I'm coming from, because usually we have a whole spreadsheet of all their debt, where it is, and how they need to get themselves out of the problem before they create a new one.
Yeah, but I come up with strategies to accomplish whatever whatever the new goal is to accomplish. And
absolutely. This fourth quarter, we're trying to finish strong with Winvesting and understanding how to Winvest to be able to beat inflation and increase your income in retirement. So that's what the topic is. So imagine, this is the question, Alex. Someone wants to beat inflation and increase their income in retirement years. What are some ideas and things? How would you talk to them about that thought?
So the last quarter was huge, right? The diversification. Mm-hmm. Because there's not going to be any one product out there that's going to accomplish that goal. So there's nothing in the drawer that says that. There's not,
like baseball, you look for a 5-tool player. There's not a 5-tool investment. There's good investments, but not the one that does everything you need.
Right. There's no BJ Surhoff of investments. That guy was great. Anyway,
yeah, he was.
So you got to find out, what do I have? What do I not have? Right? Do I have a pension? Do I have Social Security? Do I have taxable investments? Do I have non-taxable?
Right.
What do I have? Mm. And then that'll tell you what you don't have or what you have too much of. So then we come up with a combined answer where we're going to have some income that's going to be flat, guaranteed, some that may rise. And then we're going to have investments that are going to grow over time and produce income, some through dividends, some through growth, but we have to spread it all out. Boil it down to, simple math equation. If we're taking a 4% withdrawal, we want to earn 6.
Yeah. Or 8.
I mean,
you'd rather earn 8 if you're good.
I want to earn more than 4.
Okay. Now, without any risk, of course.
Well,
no, that's impossible to try to do that. Now, the idea here is that you want to do a bunch of different things. That means you need different investments to provide it. If you have one investment, it'll provide one thing. Like if you had all your money in a CD, it'll provide interest. Now, a few years ago, it didn't provide interest, so it wasn't a retirement source. Now, a decade ago, and back when interest rates were 8% and 10%, people lived off the interest. The sad part is they didn't diversify back then because they got so much interest. They thought, that's the win for my lifetime. Ended up, as they kept renewing lower and lower and lower, they had to then change their investment philosophy to try to keep their income flat.
Right. You start pulling from principal and your whole strategy fizzles out.
One of the problems we see in retirement right now is this. People with pensions don't understand that pension will never keep up with inflation. Never. And what I mean by that is The states and the governments have redesigned their pension. They keep redesigning it with different calculations for their inflation rate. They use simple interest. They cap it at 3%. There was one I heard last year, the cap was 3%, but they had in the state of Maryland, they had to go to a pension board and ask for a higher raise, a one-time legislative raise on the pension because they had enough money in there to afford it. And that's rare.
Very rare.
But the idea is this. You need investments outside of your pensions. You can't just have pension only. Those investments, you're going to need them to grow. The only way to beat inflation is to have some money at risk. CDs are considered constantly depreciating. And the reason is that no matter what the rate is, typically it's not going to be higher than inflation after tax. If you get a 5% CD, that's great, but what's inflation and taxation? Are you higher than that? Probably not.
So if you lose 80% or 20% to taxes, just for round numbers, you're at 4.
Right? And inflation's at, say, it could be 3, 6, 8, whatever it's been over the last few years,
100-year average is 375.
Right. And so are you really making money or are you constantly depreciating? I think laddering gives us better ability to earn higher rates on the fixed side, but that's not all your money. Then you build a diversified piece and you got to beat inflation with things designed for growth. That is U.S. stocks. It could be value or growth. Understanding those are two different ways of investing. Could be large, medium, or small. Different size of companies to buy. Then you got to add in international, global, small, and large combination.
Emerging markets.
Absolutely.
Frontier markets. I mean,
Frontier, you're investing in Mars now?
I think it's like where the cowboys are at.
Nice.
I don't know.
Yeah.
Frontier markets.
It's all Yellowstone these days, they say.
But like emerging markets, do you have too much exposure there? Do you understand how the U.S. dollar, which everyone here listening to this show is overexposed to the U.S. dollar? We live here.
Right.
How does that impact our investments in emerging markets, in foreign companies? We got to know these things.
Right. So you're investing your money. The idea is this. Okay, why am I investing it there? And what's its purpose? Imagine that you come in to see us and you have your information and we go through it and we call that your financial fingerprint, which is where you are right now. The thing to look at is, would you buy what you already own? Or it's like, nah, I'd buy something different. And then why would you buy something different? Maybe sometimes you own something that you've had a long time and it's way down and you're like, I don't think that's coming back anytime soon. I need a change to improve your portfolio. Perhaps you had one investment, did great, and now it's too large of a piece of your portfolio, and you got to trim that down. These are all concepts that we have to do.
Yeah, and the right portfolio construction takes the emotion out of it because it's very simple to see which side of your portfolio has skewed. Mm-hmm. And it's always going to go one way or the other, right? In a down year for equities, your safe side's going to be up because it didn't go down. So we always are able to find out. The market will tell us where we pull money from.
Yeah, that's on the withdrawal side. One of the hardest things I've seen for people is sometimes they will listen to lots of news, a lot of information, and try to invest as of today, not as of tomorrow. What I mean by that is they're not looking past just the near term. They're not looking at the future. They need to look longer term. If you're looking for growth, it must be invested long term. You must not only look short term on when to buy, but you got to look at, is this a long term hold? Does it fit?
And if you're hearing about it on the news, you're not the first person to hear about it.
It's too late to buy.
You've already missed it.
Typically, if someone's being interviewed about their stock, usually they're trying to get it to go even higher than it already has.
They are not coincidences when CEOs are on TV.
Yeah. Usually they come out with news, usually positive news, even negative news.
Or bad if they want to, how they want to spin it.
When the markets are tough, typically larger companies will have announcements and throw out all the junk. They'll throw out all the stuff they can to get it down. And then after that, all of a sudden it sounds all positive because that's what they have left. It's positive on the way back.
Right. Whenever there's a storm, everyone throws out all their garbage.
Well, imagine there's two ways to tell a story, a positive way and a negative way, right? And that's sometimes sales will do that. what we want to try to do in your planning is look at both sides of retirement for you, the income, the growth side, the idea that you need to have stability. We really like to build your retirement plan based on your need, addressing the need. If you have no debts in retirement, your need is less, and which means your money can last longer because you don't have to have this large fixed piece. It's a really nice way to design your retirement years.
And you need to know what assumptions you're using, because if you're sitting there on your 401k dashboard and it says, "Oh, things are sunshiny" or whatever, for your retirement.
Yep.
What does that even mean? Because I bet you they're using a 3% increase on Social Security. Who knows what rate of return they're using on the investments? Who knows what they're using?
Well, I logged into someone's 401k, and so they got papers saying you're out of your job starting in July, right? And then on the website says at 65, with all these escalating pensions, escalating contributions, which they don't get to work that because they're out. Even the company website doesn't apply to them. Applying planning to them and knowing your number is all very, very important, and understanding is why we did this show today. We call it Winvesting. It's winning and investing. Understanding that winning in retirement, you have to invest properly. And that's what we do, is try to help with that. Thanks very much, Alex.
Been a good talk, Brian.
I appreciate that. Today we covered Winvesting. If you don't know what that is, call us and let's talk about how you can win at investing. We look forward to talking to you at that time. We want you to win in your retirement by taking the advantage of this opportunity to begin planning with us at Acres Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at acresfinancialgroup.com. Scroll to the Schedule a Meeting section and let us know you'd like to schedule your free meeting. That's acresfinancialgroup.com. Or give us a call at 833-WIN-RETIRE. That's 833-WINRETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to acresfinancialgroup.com or call us at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Akers Financial Group offers securities through Archedios Capital, an SIPC and FINRA member firm. Advisory services are provided through Archedios Wealth. Akers Financial Group and Archedios do not share any common ownership. Neither Archedios nor Akers Financial Group provides tax or legal advice. Advice given on winning in retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, and/or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment. Examples and scenarios shared are meant to be for illustrative purposes only. Past performance is not indicative of future results.